You guys for sticking around. My name is Michael Pappas. This is Joseph Trabala and Tyler Prebor. We're here today from the University of Florida to present to you our buy recommendation for Bloomin' Brands. So Bloomin' Brands is a restaurant holding company that originally IPO'd in 1991, then consisting of just 49 Outback Steakhouse restaurants. The company was bought out in 2006 by Bain Capital. Bain then took the company public again in 2012. Now today, Bloomin' still remains with 4 core concepts: Carrabba's, Bonefish, Fleming's, and the original concept Outback Steakhouse, which today still makes up a majority of the company's revenue. Now as of Friday, shares were trading at $23.61, which represents a market cap just below $3 billion. We're extremely excited about the opportunity at Bloomin' Brands because we think it offers an extremely attractive risk-reward profile. We see growth that's going to far outpace the peer group as the company capitalizes on significant opportunities in the emerging markets. At the same time, cost and productivity initiatives are going to grow margins to at least peer levels, a goal that management has clearly stated and we're confident they're going to meet or exceed. Also, through our analysis, we identified an upcoming debt catalyst that we think will lead to a significant and material beat to earnings per share as soon as next quarter. Also, management has recently shown us that they're really ready and willing to return cash to shareholders, a trend that we not only see continuing but increasing moving forward, which is why we issue a buy recommendation for Bloomin' Brands in a $30 price target.
So now we're going to go into the industry overview and a competitive analysis of that industry. The restaurant market industry is broken up into 4 subcategories. Those include fast food, fast casual, casual dining, and formal dining. Casual dining owns 1/3 of the entire market, which is the largest individual share of any of the 4 subsectors, and realized modest same-store sales growth of 1.9% in Q3 2014. Bloomin' Brands is encompassed within the casual dining market, owning 4.5% of that U.S. market. They actually outpaced peers, doubling the same-store sales growth of 1.9% in Q3 of 2014. Now we're going to transition into competitive trends that players in this market must address going forward. Those include a saturated U.S. market, a lack of prime real estate within the U.S., and changing consumer preferences favoring a faster casual dining experience. Bloomin' Brands is addressing a saturated U.S. market by leveraging a local and experienced management team in locations mainly abroad where middle-class growth continues, especially Brazil. They're addressing a lack of prime real estate in the U.S. by renovating instead of buying new sites when they can, and internationally buying cheaper sites where there's less competition. Lastly, they're addressing changing consumer preferences by offering an online roadmap and online ordering and a digital roadmap, which they expect to save $50 million per year from 2015 to 2017. These successful solutions that Bloomin' has come up with to address these trends have paid off, as each of their portfolio concepts owns a top 5 market position within their respective subcategories.
Now to dive a little bit more into the investment opportunity here. Our buy recommendation is largely driven by the increasing earnings and margins over the next 5 to 6 years. This is largely in part driven by slowing domestic growth coupled with rapid expansion abroad in higher margin stores. To get a little more granular on the margin opportunity, as mentioned by Tyler, the productivity initiatives will save about $50 million a year. Additionally, relocation of existing units typically comes with an immediate 20 to 40% boost to sales with corresponding margin increases. And finally, Brazil, which sees operating margins of about 10% versus 5% in the United States. What's driving growth in Brazil? It's largely the growing middle class. There's also a lot less competition. It's a highly fragmented restaurant industry. Bloomin' has actually been in the country with Outback since the early 1990s, and the chain is extremely popular in the country. It has the largest market share in the restaurant industry by far. Its nearest competitor has less than half of its market share. And the higher margins are largely driven by the higher cost of goods sold, lower cost of labor, and finally higher per store revenue. We also see a near-term debt catalyst which will be accretive to earnings per share. The term loans were refinanced in 2014. The new covenants that came along with these require them to prepay debt with 50% of their excess cash flow until their debt to EBITDA is below 2.5 times. We see them paying this debt off rapidly and decreasing their debt to EBITDA to below 3 times by year-end 2015. Sell-side estimates and models largely neglect to account for this rapid paydown of the debt that is actually required by the covenants, we believe leading them to overestimate interest expense. We believe that this will lead to a 7% earnings per share beat in 2015 and a 30% beat in 2016 to earnings consensus estimates. Finally, management has shown that they're ready to return cash to shareholders. In December of 2014, they initiated their first buyback of 24 cents per year and authorized a $100 million share buyback for 2015 and 2016. Of this, they've already repurchased $70 million worth of their shares, which we believe shows that they believe the stock is currently an attractive investment and shows the potential of them to expand this buyback program in the future. Additionally, as you can see in the chart in the bottom right, we conducted an analysis of restaurant industry peers and their performance after the initiation of a buyback. This is outperformance. As you can see over a 2-year period, it's pretty significant at about 25%. Management's use of cash first goes towards CapEx, then to pay down debt, which is required by their covenants, and finally to cash back to shareholders in the form of buybacks and dividends. We believe that as debt is paid down rapidly, a bigger portion of the cash flow pie will be available to be paid back to shareholders in the form of buybacks and dividends, acting as a medium-term catalyst for the stock.
Next, I'll discuss our financial analysis and valuation. So for starters, we took a bottoms-up approach to project revenue based largely on management's guidance, as well as per-unit historical numbers for revenue by restaurant concept type. So from there, we came up with the following projections. Now, I'd like to point out that even our most optimistic scenario is fairly conservative, as it assumes that management adds new restaurants on the low end of their guidance. Since the company's IPO, they've been at the high end or above that. Also, our base case is further conservative, assuming that management actually misses new store guidance numbers. So from there, we came up with the following projections. So we assume the company can grow the top line to 7 to 9% per year, something that we're very confident in. Now, this top line growth, coupled with expanding margins, should lead to significant EBITDA and free cash flow growth. So the core story here is essentially expanding margins, coupled with the company's deleveraging will lead to significant and rapid earnings per share growth, far outpacing not only the peer group, but current investor expectations, which we think will lead to significant share price appreciation. Next, we compared the company to its 6 closest peers and found that it currently trades at a moderate discount. Now, we attribute this discount largely to a misinterpretation by investors of the emerging markets opportunity, as well as the fact that the company currently does have more debt than its peer group. However, as Joe mentioned, as the company does delever rapidly, and as investors do realize the significant opportunity in the emerging markets, we see this multiple expanding to at least peer levels, which would lead to a valuation of roughly $31 to $33 a share, or 30 to 40% upside to Friday's close. For our intrinsic valuation, as mentioned before, we see rapid free cash flow growth in the coming years. Now, in order to account for some of the risk in the emerging markets, we also utilize the Goldman Sachs model for the cost of equity in the emerging markets, which helped us to arrive at a weighted average cost of capital just below 9%. After sensitizing this and our other core assumptions, we came up with the following valuations. And even in our very conservative base case, we see the company currently trading at a 6 to 19% discount to its intrinsic value. Other valuations we use included a REIT valuation, assuming the company spins off its restaurant properties into a REIT, as well as adjusted present value analysis in order to account for the rapidly changing capital structure. However, we ended up relying corely with our discounted cash flow analysis and comparable companies analysis, mainly our EV to EBITDA multiples, in order to arrive at a $30 price target, which represents roughly 27% upside to Friday's close.
Now to dive into the risks a little bit. As our buy recommendation is largely driven by the growth opportunities abroad, obviously the dollar has been very strong over the past year. This is a big risk to companies with significant earnings abroad. We think this risk is largely overestimated by the street due to the fact that the company is not actually repatriating any cash from Brazil. As you can see in this chart here, the Brazilian real is near historic lows versus the dollar, and we believe by the time the company actually does repatriate cash from Brazil, this will revert to the mean. Additional risks include minimum wage increase, food inflation, a rebound in the price of oil, execution risk abroad, and leverage, which is above peer levels. In our bear case, we assume that management only gets 60% of their margin goal over the next 5 years. Additionally, we assumed new store openings that is 40% below the low end of their guidance range, and this comes up with an intrinsic valuation of $21 per share, which is about 10% downside from the recent close.
In summary, we're extremely excited about what we see to be a Bloomin' opportunity. As mentioned before, we see very attractive risk-return profile with Bloomin' Brands as the company capitalizes on its significant opportunities in the emerging markets. Cost and productivity initiatives we're confident will lead to a growth in their company's margins, and this coupled with our near-term debt catalyst to beat earnings per share and medium to longer-term confidence in management's willingness to return cash to shareholders is the reason why we'd like to reiterate our buy recommendation for Bloomin' Brands and our $30 price target. So with that, we'd like to thank you guys for the opportunity and open it up for Q&A.